Adrian Mowat, Managing Director, Chief Asian and Emerging Market Equity Strategist at JP Morgan, is now joining in. Adrian, pleasure to have you on the show on a very interesting day. 52-week highs for this Indian market. Has the move in the last 1 month surprised you? That's the first part of my question. The second part, do you see more of it?
Yeah, I think the context of this is it's slightly disappointing. Remember that India fell relative to emerging markets after demonetization. Year to date, it's moved in line with EM, but on a 3-month view, you're still lagging emerging markets. And I think when I sort of listen to the commentary that's been going on about this move in the Nifty, it's ignoring a global context, which is that capital markets are performing well, risk assets like equities are performing well.
So what do you see as the way forward now, Adrian? By the way, good afternoon and thanks for taking the time out. Are we staring at a massive summer rally in global equities that could take the Indian markets further up as well?
Well, it's a little bit cold at the moment for this to be a summer rally, but I think that the dynamics, though, globally is that we should think about perhaps a loss of momentum in the equity moves. We have challenges in the US. The US equity market has moved up with the expectation of fiscal stimulus, including corporate tax cuts. It is possible that they can't get agreement on border adjustment. If that's the case, then there could be market disappointment around the Trump administration's ability to give you a fiscal stimulus, to give you lower corporate tax rates. So I think we should be conscious about those risks. We should also be conscious about European political risk. On the 23rd of April, you've got the first round of the French presidential election. I think the market will want to price in some sort of risk that you get a victory by the National Front, by Marine Le Pen's party. That victory in the second round, which we think is a low probability, but it would be a very disruptive event if it happened, would result in question marks about the euro. So I think there's a case for being a little bit more cautious on equities globally after the type of move that we've seen since the 8th of November.
You know, listing down risks is fine, Adrian, but when the momentum is so strong as it is in a market like ours, you feel a little left behind if you don't participate. So if one wants to participate at this point, what are the sectors that you see that still offer value now?
Yeah, so I think your question is what still offers value. Maybe phrase it in a different way. Where do we think that we'll continue to get the good news, the momentum news? Our positioning in India at the moment is that we've been avoiding the sectors in which you have risk from US policies. We're underweight Indian IT, we're underweight Indian healthcare. We don't like expensive defensives, so we're underweight consumer staples. What we are overweight is real estate, building materials, some of the contractors. And at the moment, we're in a process of analyzing how the results season's been for consumer discretionary, as well as for financials. Broadly, I think the demonetization disruption proved to be more modest than feared, but we did have stock-specific disruption in the consumer discretionary space.
Adrian, where does that leave telecom in India? Big headline-making sector. Analysts now seem to think that Reliance Jio is going to make money faster than earlier anticipated. There's lots of M&A. People are hoping that maybe the worst of the pricing war is behind the sector. What's your sense?
Yes, I still think it's a difficult investment decision for a buy and hold investor. Much of the activity in the sector has been speculation around either the marketing strategy, the pricing strategy of Reliance, or speculation around consolidation, around further M&A. And it's really difficult to add much value in that situation. The other thing I'd highlight from my perspective as the global emerging market strategist is the market cap of Indian telecom is very low. Perhaps where it's more significant is how it impacts the energy sector, with the biggest stock in the energy sector, where people have been pessimistic about it because of the spending being done on its telecom arm.
But are you a believer in the telecom rally? I mean, there's as Sonia put it, a bit of a catch-up that seems to be playing out, that maybe, you know, there was too much of pessimism priced in, and therefore this 10% up move on Reliance, therefore the kind of 50-60% up move in an Idea Cellular in the last few weeks.
Yes, but, you know, I go back to this is about event trades, isn't it? So do I feel confident that I can predict the next event trade in the telecom space? No. I would say, though, if the market is pricing in some factor of consolidation and pricing in some, you know, less aggressive marketing behavior by Jio, then perhaps there's not much left for this particular rally. And I'd rather put my capital behind some of the more longer-term trends in the Indian economy rather than trying to second-guess these events.
How are foreign investors feeling about this market now, Adrian? Because, you know, although we are getting a lot of domestic participation, there's hardly anything coming from FIIs. In fact, FIIs have been selling over the course of the last many months. Is there any change in that sentiment that you see?
Yes, so the last survey we did as of the end of December, and we're going to do a survey this week and get the data for the end of January, had India by far the largest overweight in emerging markets. Now, that was overweight a market that as of December was underperforming. It underperformed in the initial rally in January. So the emerging market funds are needing to take capital out of India and allocate into markets that are performing better, such as Brazil, which is up nearly 20% for a dollar-based investor year to date.
Adrian, just pulling back to the global context and, you know, help us make sense of this. If you can lay out the different scenarios. Since the 8th of November, there was the entire, you know, sell emerging markets, go long on Western markets, particularly the US market trade that was playing out. Then the EM catch-up started up. What next? And I mean, if there is this border tax or this overall tax plan, how will that work out for a market like India? Is it going to be good, bad? Should we expect the rally to continue? If the US rally starts, you know, stuttering, then what does that mean for the Indian market?
Yeah, so quite a few questions there. So specifically, let's deal with border adjustment. We're positioned with the assumption that there is a very, very strong desire to cut the corporate tax rate in the United States. Corporate tax rate in the US is 35%. That is the highest in the OECD world, highest in G20. They would like to get that down to somewhere nearer 20% if you look at Speaker Ryan's proposal. The only way to achieve that and be revenue neutral is border adjustment. Border adjustment would be very negative for the Indian IT space. It would also be negative for Indian healthcare in terms of generic exports to the United States. So we think the market is still underpricing the risk of this. And remember, for the Indian IT sector, it compounds the H-1B problem, which perhaps is better reflected in share prices. So I think there's that dynamic. Now, the other dynamics in terms of why is EM doing well? Well, this year, the earnings growth forecast is 15%. We think that's a very reasonable number. Positioning in emerging markets is underweight by global investors. Valuations in EM in aggregate are at a meaningful discount to US equities. And I think the fears such as strong dollar are actually going to prove to be misplaced. We're seeing some very interesting dynamics in terms of improving cash flow in places like China, which is good for financial risk. And I think some of the fears around the Chinese renminbi will prove to also be misplaced. So I remain bullish relative on EM versus DM. But as I was commenting earlier about some of the near-term risks as we move into the second quarter, perhaps the sort of global equity rally will lose a bit of its steam. And it's been a pretty decent move from November.